Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at CoreWeave.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we jump into the numbers, we want to mention the special 14-day trial link below in the description for StockOracle.
Right, and just as a quick heads up, that is an affiliate link. So, the channel may earn a commission at no extra cost to you if you use it.
Exactly. And we always like to remind everyone that StockOracle is an AI-aided stock research platform, right? So it's not financial advice.
No, definitely not financial advice. It's not a trading signal service, and it doesn't provide real-time market data.
Yeah, the data is actually delayed by 15 minutes for U.S. stocks, and it's end of day for OTC markets. So just keep that in mind.
And, because it uses AI, the insights and the valuation estimates can sometimes be incomplete or even just wrong.
Right. So always verify the important facts yourself. Don't just blindly follow an algorithm.
Absolutely. So looking at CoreWeave today, this is essentially the invisible, incredibly expensive engine behind the whole AI revolution.
Yeah. I mean, if you're building wealth in this market, you already know AI isn't just magic code floating in the cloud. It takes massive physical infrastructure.
It takes so much physical hardware. And the tension with CoreWeave right now is this insane tug of war between their top-line growth and their massive cash burn.
Well, looking at their fundamentals, the top-line boom is exactly the kind of thing that makes investors completely ignore logic.
Oh, the revenue velocity is staggering.
Yeah.
I mean, for the first half of 2026, they hit $4.3 billion in revenue.
$4.5 billion in 6 months.
Which is massive. To put that in context, the first half of 2025 was $2.194 billion.
So they essentially saw 112% year-over-year growth.
Exactly. And Q2 alone was over $2.5 billion. They even raised their full-year guidance to between $12.4 and $13.2 billion.
Which, by any conventional standard, doubling revenue at that multi-billion-dollar scale is a masterclass in execution.
It is. But then you look at the bottom line, and the math just sort of stops making sense.
Right, because you have to wonder how a company pulling in over $4 billion in half a year can actually be bleeding cash so severely.
Well, the net loss for that exact same 6-month period was $6 billion.
Over $1 billion lost.
Yeah. And their trailing 12-month net margin is sitting at a really grim negative 25.57%.
So for every dollar of that huge revenue they capture, they're losing over 25 cents.
Exactly. And it comes down to the physical reality of what they're building. I mean, this isn't a software app where adding a user costs almost zero.
Right, they aren't just uploading code.
No, they're buying the most advanced, power-hungry, heat-generating AI GPUs on the planet and building the facilities to house them.
And we aren't just talking about standard data centers, right? You can't just plug these into a regular commercial grid.
Not at all. The power density is so extreme that traditional air cooling just completely fails. The chips would literally melt.
Oh, wow. So they have to build entirely new cooling architectures.
Yeah, advanced liquid cooling systems, massive custom power substations. They even need reinforced real estate just to handle the sheer physical weight of these new server racks.
Which perfectly explains that jaw-dropping CapEx guidance we were looking at.
The capital expenditures, yeah. They are projecting $35 to $39 billion for 2026.
35 billion. Wait, they're expecting to make roughly $13 billion in revenue, but they're spending nearly 3 times that just to build out the infrastructure.
That is the reality of the AI arms race. The capital intensity is just off the charts right now.
I mean, Wall Street usually punishes that kind of leverage, especially with higher interest rates. How are they funding a $35 billion construction project out of petty cash?
They aren't. They are taking on a massive amount of debt. As of March 2026, their long-term debt stood at $24.859 billion.
Almost $25 billion in debt. That's like taking out a high-interest mortgage to build a skyscraper and just praying the future rent covers it.
It's a highly fragile capital structure. And because of that CapEx and debt, their free cash flow is cratering. For the first half of 2026, it was negative $10.454 billion.
Negative $10 billion. And the interest payments on $25 billion of debt must be eating them alive, right?
Oh, absolutely. Rising interest costs are a major threat here. It's essentially a debt-funded gamble.
Which requires absolute perfection to pull off. I mean, if there's a supply chain bottleneck for those cooling systems, the interest still compounds while they wait.
It does. But CoreWeave defends this by pointing to a different metric entirely. They say they aren't building these data centers on speculation.
Right, they aren't just hoping clients show up.
Exactly. They point to a mountain of guaranteed future work. The debt, in their eyes, is just the cost of fulfilling contracts they've already won.
Okay, let's talk about catalysts then, because this contracted backlog is the counterweight to all that debt.
It's the ultimate catalyst. Their revenue backlog has reached $104.2 billion.
$100 billion. That's wild.
And with incremental commitments, the total actually pushes up to $129.2 billion.
Those are sovereign wealth fund numbers right there. And the clients aren't small players either.
Not at all. They secured a $21 billion expansion with Meta, for instance.
$21 billion from Meta alone.
Yep. Plus a major agreement with Anthropic and even a $6 billion commitment from Jane Street.
Wait, Jane Street, so it's not just tech companies.
Right. It's frontier AI research,
Hmm.
it's social media algorithms, and it's high-frequency quantitative finance. The demand for compute is everywhere.
Which proves the demand isn't just hype. But, let me play the skeptic for a second.
Sure, go ahead.
A backlog is ultimately just a promise on a piece of paper, right? It only turns into cash if CoreWeave actually delivers the compute on time and efficiently.
That is the major execution risk, yes.
And there's a metric here that seems to expose a vulnerability. It's about how much money they actually make per unit of energy.
Ah, you're looking at the contracted revenue per megawatt.
Exactly, because the GPUs themselves are kind of becoming commoditized. Everyone can buy the same NVIDIA chips, right?
Right. The chips are just a hardware purchase. The real bottleneck is the power grid. Securing the physical megawatts to run those chips is where the actual value is.
And apparently a competitor named Iron is actually outpacing CoreWeave in that specific metric.
Yeah, Iron is generating more revenue per megawatt, which means their pricing models, or maybe their cooling efficiency, is just superior right now.
So what's stopping these massive tech giants from jumping ship? If you're Meta and you see Iron can offer the same compute for less because they use power better,
You might rethink your future contracts.
See?
That $100 billion backlog feels a lot less ironclad if competitors are beating you at the basic physics of the data center.
it's such a psychological tug of war. Massive backlog on one hand, but terrifying execution risk and massive debt on the other.
And you can see this exact tension playing out in the stock's technicals and in the market sentiment.
Let's get into the technicals because they just reported Q2 earnings, they beat expectations, they raised guidance.
And the stock absolutely tanked.
Right. A sharp 12.1% decline in a single day, dropping down to $93.17.
It was a violent sell the news event, and technically the relative strength index, the RSI, was nearing 70 before that drop.
Which means it was getting severely stretched, right?
Okay.
Overbought territory.
Exactly. When a stock is priced for absolute perfection and carrying $25 billion in debt, algorithms and traders will use any excuse to take profits.
So the market just de-risked immediately.
Yeah. And if you look at the institutional sentiment, it is completely fractured right now.
You've got heavy hitters like David Tepper aggressively buying shares.
And Cathie Wood's ARK is building a big position too. They view this as the ultimate picks and shovels play for AI.
They see that $100 billion backlog and assume the cash flow will eventually just overwhelm the debt.
But on the flip side, Viking Global, a massive institutional fund, entirely exited their position in Q2. They just walked away.
Which is concerning. But honestly, the institutional split isn't even the biggest red flag here.
You're talking about the insiders.
The insider selling is just glaring. I had to read this twice to believe it.
It's pretty shocking. There have been exactly 0 open market purchases by insiders recently.
0. Not a single executive bought a share.
None. But there have been 961 sales transactions,
That's insane.
totaling 18.3 million shares dumped by the people who actually run the company.
And that includes the CEO, Michael Intrater, right?
Yes. He liquidated over 300,000 shares right as the company announced their revenue had doubled.
I mean, how are we supposed to process that? It's like the captain of a ship telling the passengers the engines are perfect while he quietly loads his own luggage onto the lifeboat.
Well, to be fair, many of these sales are through 10b5-1 plans.
The pre-scheduled trading programs.
Right. They use them to diversify wealth and avoid insider trading accusations. But still.
961 transactions.
Yeah.
And absolutely 0 buying.
Yeah, the sheer volume combined with the vacuum of any insider buying is a deafening bearish signal. When the people with access to the daily balance sheet are reducing their exposure, you have to pay attention.
So if you're trying to build wealth and manage your portfolio, how do you even evaluate this? You have massive future revenue, but massive immediate debt,
And the CEO selling while David Tepper is buying, it's just a lot of noise.
which is why we're seeing investors shift toward AI-aided tools to filter the stuff out, right?
Exactly. The cognitive load of weighing all these variables is just too much to intuitively balance on a napkin. Traditional valuation metrics completely break down with a company like CoreWeave.
Yeah, you can't really use a price-to-earnings ratio when they're losing $1 billion every 6 months.
So platforms like StockOracle step in to organize that foundational data.
Like using their AI moat analysis feature to objectively weigh CoreWeave's backlog against competitors like iron.
Right, or using the OracleIQ tool to appraise their financial health pillars. They even have OracleValue for intrinsic value estimates using discounted cash flow models.
But a DCF model is hypersensitive to long-term assumptions, isn't it?
Incredibly sensitive. When you're dealing with a $100 billion backlog that pays out over a decade, slightly tweaking the assumed interest rate completely rewrites the valuation.
Which brings us back to those limitations we mentioned at the top of the show. If the model is that sensitive and the AI can be wrong, isn't a tool like StockOracle just a highly advanced calculator?
Well, yes, in a way. The tools aren't meant to predict the future.
So why not just trust your gut when you see the CEO dumping 300,000 shares?
Because human instinct is super vulnerable to panic and recency bias. An organized platform forces you to mathematically weigh that insider selling against the $21 billion meta contract on the other side of the ledger.
It strips away the emotion.
Exactly. It doesn't give you a magical answer, but it ensures you aren't flying blind.
It provides cognitive discipline. And looking at the raw math is exactly how we have to reach our final verdict on CoreWeave today.
So synthesizing everything. The massive top-line growth against the 25% net margin bleed.
The 100 billion backlog against the 25 billion debt stack.
And the institutional buying against the mass insider selling. Our overall rating lands squarely at a 5.
A completely neutral stance. We aren't telling you to buy, sell, or hold this stock.
No, a rating of 5 means it is a high-wire act. CoreWeave's relevance in the AI ecosystem is undeniable, but it's entirely funded by a rapidly expanding debt stack.
So for our long-term view to shift from neutral to bullish, what do they need to prove?
They have to prove they can cross that tightrope. They need to convert those massive paper contracts into actual free cash flow without issuing more debt just to keep the liquid cooling systems running.
They have to prove it scales profitably.
Exactly. Because if interest rates stay high, or if competitors like iron and steel market share, that neutral rating could turn bearish really fast.
It's a precarious spot, which leads to a final risk, kind of a bear case thought to mull over.
The systemic risk nobody really wants to talk about.
Right. CoreWeave's debt is only acceptable if we assume the demand for AI compute goes up forever. But what if the revolution hits a speed bump?
You're talking about the threat of dark GPUs or oversupply.
Yeah, we saw this in the late 90s with the fiber optic cable boom. A massive overbuild that led to years of unused capacity.
If hyperscalers realize they bought way more capacity than they can monetize, the demand curve flattens.
And if that happens, what happens to the infrastructure companies holding $25 billion in high-interest debt for data centers nobody wants to rent?
It would probably trigger a cascade of defaults across the sector.
Exactly.
Yeah.
So are we looking at the foundation of the next global utility or the biggest debt-fueled overbuild in tech history? Only the math will tell.
Absolutely.
Well, that wraps up our analysis for today. Remember, our overall bullish score sits at a neutral 5. We are strictly neutral on the long-term view until they prove their cash flow model.
And if you found this breakdown helpful, please consider subscribing, liking, and leaving a comment below.
And don't forget to check out the special 14-day trial link in the description for StockOracle. Again, it is an affiliate link. It comes at no extra cost to you, but it helps support the channel.
Just remember, StockOracle is an AI-aided stock research platform. It's not financial advice, no buy or sell signals, and the market data is delayed 15 minutes for U.S. stocks and end of day for OTC.
And those AI insights can be incomplete or wrong, so always do your own research. Thanks for tuning into Smart Wealth with Joshua, and we'll see you in the next one.